Joining our closing bell exchange to talk about the market action today, we've got Rene Nourse from Urban Wealth Management, CNBC market analyst Steve Grasso from Stuart Frankel, and Rick Santelli, as always, from the CME Group in Chicago. So, Steve, a little bit of strength in financials again. I think that's the third day in a row off the back of Morgan Stanley earnings. Finally, some strength in financials. So, something else besides tech has to do the heavy lifting with the market in order to keep the gains, in order to keep the market moving forward. But yesterday, I think it was all about Chairman Powell. This morning, we saw the Powell pop as well in the marketplace. We saw the markets rally. So yesterday, you had Netflix. You had Powell making bullish, or I should say, dovish statements. Was it? Was that what it was? It wasn't hawkish. Maybe that was. It was definitely not hawkish, and I think that's a little more apropos. It was definitely not hawkish, and it is gradual. It is understood to the marketplace as being dovish, and that's what the marketplace needs. Instead of a robotic raise, they wanted to see a wait and see, and Rick talks about this a lot. The yield curve is at the top of everyone's mind. That's been the headwind for the overall market, and you have to compensate that. I know the Fed keeps saying it's different this time. He's got to convince the market, and it looks like the market is convinced, at least for today. I will say that Griffin's statements today, talking about nothing but rosy skies ahead for 6 to 9 months, the market is a forward-looking pricing mechanism. Is that 6 to 9 months in the marketplace already? And that's what investors have to decide.
Rene, we just heard from Oscar Munoz there about how airlines are going to have to deal with the high oil prices, high energy cost prices. Is that an opportunity, therefore, to be getting into the energy sectors themselves?
I think so. And actually, when I was on a couple months ago, it was the day where the energy prices had really pulled down the market, and it was a great time to get in. I think that energy prices are still going to rise up pretty significantly. It's going to be interesting how it's going to affect the rest of the industry. But the oil and gas production, for example, as an ETF, is a great way to participate in that upward bound movement. It's already up 15% year to date. So I'm looking forward to still being in that space. And just generally, U.S. energy stocks is going to be an awful great space to be in as well.
Rick Santelli, take your pick. Chairman Powell, higher 10-year yield today, disappointing housing starts, and this debate about how long the better growth can last.
You know, let's try to deal with all of them quite quickly. In terms of the growth, okay. What I find is most traders are enamored with the notion we're looking at a 4+% GDP for the second quarter. Most suspect we're going to have a solid 3+ for the third quarter without any exogenous forces that may act in the future. It's hard to get psyched up about a recession with those fundamentals. With regard to today's housing number, I was there at 8:30. Yes, it was down over 12%. But the main number was the best number in 10 years, so there is a bit of an asterisk there. As far as the yield curve and Jay Powell, they're just glued together. Most traders are just enamored with the pragmatism of Jay Powell and the fact that he's going to try to snug up. We need to snug up. We need to get some insurance, but he's going to monitor what type of signal he gets back from the market, even though some of the signals may be impaired due to inventory of treasuries. So as steady as she goes, it's still going to be the 20th session in the row that 10-year note yields look to be closing in the 280s.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.